Hi, Adam Khoo here. So I'm going to do a quick analysis on the US equity markets, or the public calls it the stock markets. Because on Friday, we had a pretty big sell-off, pretty significant sell-off, where the Dow Jones dropped more than 600 points and the S&P 500 more than 50 points. And the media has been playing it up, making a big deal out of it because it is supposedly the biggest drop in the last 2 years, and a 600 drop on the Dow is pretty rare. So is it time to panic? Is it a change in trend, or is it a pretty healthy correction? Is it time to go shopping if you're looking to buy great stocks at huge discounts? So let's do a quick analysis. So looking at the charts, you can see that US markets have been on a very clear uptrend for the last 10 years. In fact, well, 9 years to be exact. And so again, how do you tell it's an uptrend? If you've watched my earlier videos, we use moving averages to tell a clear uptrend. So on a clear uptrend, what you have is the moving averages in sequence from the lowest moving average to the biggest moving average. So we've got the 20 EMA, 20 exponential moving average that measures the short-term trend, the 50 moving average, the medium-term trend, the 150 moving average, and the 200 moving average. So on a very clear uptrend, you see that sequence, right? The 20, the 50, the 150, and the 200, all in sequence, and they're all sloping up. And on an uptrend, you can also clearly see the price action pattern making higher highs, series of higher highs and higher lows, as you can see over here. Okay, so we have been on a clear uptrend, and in my opinion, looking at the charts, the sell-off on Friday is a very healthy correction or pullback in the US equity markets. In fact, it's long overdue, because remember that on a very clear or healthy uptrend, prices don't go up in a straight line. They go through wave patterns of impulsive wave and corrective waves. Like again, a breathing pattern. So impulsive wave is like breathing out, right? Corrective wave breathing in, and breathing out, breathing in, breathing out, breathing in, and that's how the wave pattern unfolds. And what happens is when the price moves up too much without pulling back, it's kind of like breathing out, right? You breathe out, you can't breathe out forever. You've got to breathe in order to take the next breath out. And one of the most important things to look at is really the moving averages, specifically the 50-day moving average is where, we call it the average because that is where average value lies. So whenever the price goes too far from the moving average, what happens? Eventually, it has to snap back to the moving average. It has to snap back. And the danger happens when the price moves too far from the moving average. It gets technically overbought. And you never ever want to buy when price is far from the moving average, because you're buying when it's technically overbought, when it's technically overstretched. Right? Kind of like a pendulum, it has got to snap back to the moving average. So a low risk entry would be always to enter near the moving averages, where the price is selling at its average value. That's what averages mean. So if you take a look at the charts, you can see that the market, the US markets, have been going up very consistently and have been going up pretty far from the moving average. So again, a correction was overdue. It's got to snap back eventually, and I think it's snapping back right now. In fact, it is snapping back right now. So you can see this corrective wave coming in right now. Okay. Now the question you could always ask is, when the price goes through a corrective wave, how deep is the correction? Now you never know until it happens. No one can predict the future. So oftentimes what you see is, in a very shallow correction, like this is known as a shallow correction or shallow pullback. In a shallow correction, it finds support at the 20 moving average, right? It bounces off the 20 moving average like so. Boom, there we go. Boom. So these are shallow corrections. And normally during shallow corrections, the price retraces about 38.2% from the impulsive wave to the corrective wave, 38.2%. If it's a slightly deeper correction, like a medium-term correction, it will tend to retrace to the 50 moving average. And normally that would be a 50% correction, usually, or 61.8% correction. So if you take a look at some recent points, you can see that this was a shallow correction, shallow correction. This was a deeper correction where it found support at the 50 moving average. So the 50 moving average is the next level of support, as you can see, right? So at this point of time, looking at the markets, you can see that the price easily broke through the 20 moving average. So this is not a shallow correction. So the question is, where is the next level of support? Well, the next level of support would be the 50 moving average over here. All right, so I expect that the market will go down at least another 500 points to 600 points to the 50 moving average, which is a very, very healthy medium-term correction, as you can see, finding support at the 50 moving average. Okay, now what happens if the price breaks the 50 moving average? Well, then the next level of support is the 150-day moving average, which is the green line. So that is an even deeper correction. If it breaks the 150-day moving average, then the last level of defense is the 200 moving average. So the 200, which is the red line, is the last level of support. If it breaks the 200, the market could potentially get very bearish and reverse into a downtrend. So we are pretty far away from that. We are just below the 20 and we are still above the 50, so it's a pretty healthy correction from here. Now, what's really important to understand, whether you are a short-term trader or a medium to long-term investor, is how do you tell the difference between a healthy correction, healthy dip on the uptrend where you buy more and continue the trend, or a change in trend where the entire market reverses from an uptrend to a downtrend, from a bull market to a bear market. How do you tell the difference? And the way to tell the difference is, number one, looking at the price action. Number two, looking at moving averages. So again, as long as the moving averages remain in sequence, right? The 50 above the 150 and the 150 above the 200, then we are on a very, very clear uptrend. So any kind of dip would be a good buying opportunity. So again, I would not look to buy right now yet because again, I'll wait for it to find some kind of support. So is it going to find support at the 50? If it finds support at the 50, it starts bouncing, you can start adding positions, right? If it breaks the 50, look for the 150, breaks the 150, look at the 200 moving average. All right, the same is true whether you're trading Forex or cryptocurrencies. And I'll create another video on cryptocurrencies in a short while, and you can see the same pattern. In fact, right now, Bitcoin has broken the 50, the 150, and Bitcoin, in fact, is finding support at the 200 moving average. It's the last line of defense. So if Bitcoin breaks the 200-day moving average and can't get back above it, then Bitcoin could potentially go into a major bear market downtrend. But I'll talk about that in another video. Okay, in fact, let's kind of like wind back the clock back in time. When was the last time the US markets went on a bear market, went on a huge downtrend? And the answer is about 9 years ago. Oh, sorry, not 9 years ago, 11 years ago, during the subprime financial crisis, the mortgage crisis, right? So let's go back to that. In fact, you can see this entire 20-year history. I've got it mapped out here. And going back to the financial crisis, this was it. Okay, so you can see the market was on a very clear uptrend. And again, it was finding support at the 50 moving average. Okay, and again, when it breaks the 50 moving average, like I mentioned earlier, it finds support at the 150. Can you see that? The green. So that's the next level of support. Okay, then it finds support at the 50 again. It breaks the 50, it finds support at the 200 moving average. Remember? So again, moving averages are like levels of support. When it breaks one, there's the next level, next level. If it breaks all the levels, goodbye, Charlie. All right. And over here, you can see again, over this part, this was a very, very dangerous sign because again, it broke the red line. And again, the red line is the 200 moving average, the last level of defense. So again, this was 11 years ago during the financial crisis that where markets collapsed 60% thereafter. Okay, so it broke the 200 moving average. So this was already a big warning sign over here. But the ultimate indication of a change in trend is when the 50 moving average, the blue line, crosses below the green line, and both moving averages are sloping down. Remember, if the 50 crosses below the 150, but the 150 is still sloping up, it is not a confirmed downtrend. The important thing is to look at the slope of the moving averages. So both moving averages have to change slope. They must be flat or sloping down. So over here you can see the 50 was sloping down, the green has flattened. So this was a confirmed, 100% confirmed indication of a change in trend, or rather a downtrend. And that was where you had to sell. You had to sell everything, get out of the markets, because what happens after the 50 crosses the 150? I call it the death cross, right? You can see after that, that's right, markets go into a huge downtrend as so. Boom, all the way down, right? And this was kind of like a 60% drop, okay? So you never ever hold, you never ever buy on a downtrend, because on a downtrend, low gets lower, cheap gets cheaper, all right? So don't worry, we are nowhere near there yet, because again, the 50 is above the 150, it's not crossover yet, we're still on a clear uptrend. But just to show you what has happened in the past, so you get prepared if a change in trend occurs. Another way you can tell a change in trend is by looking at the wave pattern. So again, on an uptrend, you see higher highs and higher lows. Okay, you can see over here, this is a very clear uptrend. You can see higher highs and higher lows, right? Now, some people think that the moment I see lower highs and lower lows, it's a downtrend. No. The market likes to fake people out. Sometimes you find lower highs and lower lows, but it's not a downtrend yet. It then goes back to higher highs and higher lows. So one of the things I found is, besides looking at moving averages, a downtrend is also signal, or a bear market is signal, when you have got 4 lower highs in a row. Okay, 4 lower highs in a row. What do I mean by that? Okay, so notice over here, we have got from this high to this high. Okay, this is the same high, and that is a lower high, right? So that's one lower high and a higher high. So that's not the change in trend. And then from here, you have got a lower high, a lower high. Can you see that? So lower highs, lower highs, lower lows, lower lows. So some people think, hey, that's a change in trend. But remember, we need 4 lower highs in a row. Those are not 4 lower highs. Okay? Because what happened after that was we made a higher high. Can you see a higher high? Higher high and a higher high. So this kind of like broke that pattern. Okay? And then we made higher highs again, higher highs again, higher highs again. So now over here, take a look. From here to here, we have got lower high. From here to here, we have got a lower high. And from here to here, we've got lower high. There you go. 1, 2, 3, 4. 4 lower highs in a row. That's it. Game over, baby. That's a change in trend. You gotta get out, you gotta sell everything, and better still short the market. So when you short the market, boom, the whole thing will collapse. Okay, and you have this major bear market that usually lasts for 2 to 3 years, that everything's gonna go down, cascading down, right? So again, the question is, how do you know when to get back in, right? So again, you have to wait for the downtrend to reverse back into an uptrend. And how do you tell? Again, remember, on a downtrend, you see the opposite, the exact opposite, right? On a downtrend, what happens? The 50 moving average is below the 150 below the 200, and the moving average is acting as a resistance now. So once price is below the moving average, it acts as a resistance, as you can see. And an uptrend is signaled when, again, now is the opposite. The 50 moving average crosses back above the 150 moving average. There you go. Can you see that? So when you see the 50 crossing back above the 150, and everything changes sequence again. So now you can see the 50, the blue, is above the 150, the green, 150 above the 200, and this is the point where you re-enter the markets to catch the new trend up. And you can see then the trend, boom, it goes all the way up again. Okay, this was actually a change in trend going down. all right, and you could have exited there to take profits, and the trend then reverse back up again, and you ride the trend all the way up. Okay. So remember, that as investors and traders, we can't predict the future. We are not fortune tellers. All right. We have got no idea when a trend will reverse. All we know is where the trend is at any moment in time. So as long as you follow the trend, right, you buy, you hold on an uptrend, you stay long on the uptrend. And the moment you see a change in the trend, right, from a bull to a bear market, you have to exit your long position, sell everything, and go short the market to make money as it goes down. So again, going back to where we are today, as you can see, despite that big 600-point drop in the Dow Jones in the market, moving averages are clearly in sequence. We have broken the 20, but we still have support at the 50, the support at the 150, and the 200. Okay, so based on this, what's the strategy moving forward? Well, it depends. If you are doing some short-term swing trading, right? You're getting in and out of the markets really fast. You are a momentum trader. The moment the price goes below the 20 moving average, momentum is no longer strong in the markets. You don't have very strong momentum anymore. So you can still take some long positions for swing trading, but only if they are very, very strong and good setups. Okay, because the momentum is not as strong as it was a couple of weeks or months ago. You could, at the same time, start to take some short setups as well. If you see some good short setups, you can take short setups. So you have some long setups and short setups, and you can make money on both of them during this period when the market is still on an uptrend, but it's going through a minor correction. Okay. Now, if you're more of a medium to long-term investor and you like to buy some fundamentally good companies, but price has been too high, it's been overbought, now is a good time to start your shopping list to look for stocks that are fundamentally good or some good ETFs, and you can buy them once you find them coming to the next level of support and finding some strength again. Okay, so personally for me, I've got a very diversified portfolio. So part of my portfolio is short-term swing tradings in stocks. Part of my portfolio, I do day trading for Forex. And part of my portfolio is more for my kids, my family, which is more of a medium to long-term investments. All right, so these are the ones where I buy fundamentally very strong and defensive companies, whether it's Procter & Gamble, McDonald's, and some growth companies like Alibaba, Amazon, and also some pretty good ETFs. The Dow Jones ETF, the S&P 500 ETF. I also invest in the emerging markets ETFs, as well as the China ETFs. And I've talked a bit about what are some really great ETFs to look at in my previous video on Outlook Opportunities 2018. So if you have not watched that video, you can watch that video. So at this point of time, again, for my longer term investment portfolio, I'm looking to buy once I see this nice retracement to enter to catch the next phase up. So for example, I can look at the Dow Jones ETF, known as the Diamonds, the DIA. So I'm just punching that in right now. You can also look at the S&P 500 ETF, right, which is the SPY. So let's let it load. Okay, there we go. So this is the Dow Jones ETF. And you can see that now this is something I've been buying for many years, right? So I use what we call dollar cost averaging. I keep investing regularly into this and riding the long-term trend up, because in the long term, the Dow Jones will always be higher. The S&P will always be higher. But along the way, you will have corrections which make good buying opportunities. So again, I'm looking to get in, but not just yet, because again, as it's going down, I don't want to catch a falling knife, right? I like to see that it finds support at the 50 moving average, finds some kind of bounce, and start entering more of this ETF, okay? If it breaks the 50, then I'll look at the 150 and start accumulating at the 150 or even the 200 moving average. And if the entire trend reverses down, then I'll just exit and let it collapse 50% and buy it back at the bottom again, okay? So the thing about investing and trading is that you can't predict the future. but you follow trends and you manage your money accordingly. That's really, really important. All right, guys. So that's it for this video. If you've got questions, you can send me an email. If you'd like to find out more about the courses which I run, you can also do so, whether it's my live courses in Asia at wealthacademyglobal.com or my online professional trading courses at piranhaprofits.com. So I hope you enjoyed it. Adam Khoo, and may the markets be with you in 2080. Hi, so if you like the video, you can subscribe for more videos by clicking the subscribe button. If you want to find out more about our live training courses in Asia, go to wealthacademyglobal.com. For online professional stock and forex trading courses, you can go to piranhaprofits.com. So this is Adam Khoo, and I'll see you soon.